Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at Apple.
If you find our talks useful, please consider subscribe, like, and comment underneath.
Because we actually do go through all of those comments, to see what you guys want us to cover next.
Yeah, we absolutely do. And today we have a really fascinating one. I mean, we've been going through the fiscal Q1 2026 numbers, the earnings call transcript, a bunch of analyst notes that just dropped.
Ton of notes today, yeah.
Right. And it's honestly wild because it's completely challenging this whole narrative we've heard for, the last 2 years. This idea that their growth is stalling.
That they're just a mature, slow-moving giant now. Exactly.
Yeah, but then you look at the headline numbers before we even started recording today, and the sheer scale is, well, it's almost hard to wrap your head around.
It really is.
But before we get totally lost in the billions, I want to set the stage for you listening. We are looking at a company that is effectively operating like a financial fortress right now, even in a pretty volatile macro environment.
A financial fortress. I really like that framing. I think our mission today is to strip away the marketing gloss, right? Forget the shiny new titanium phones and the slick commercials.
Yeah, ignore the billboards.
Right, ignore the billboards. Let's look at the actual machinery that's printing money for the shareholders. We need to understand exactly how they are hitting these numbers because the data from this quarter is telling a very specific story about pricing power.
It really is. So let's just start right at the top line because this number completely jumped off the page at me. Revenue for fiscal Q1 2026 came in at $143.8 billion. And that's just
for one quarter.
Just for the quarter.
90 days.
$143.8 billion. I mean, to put that into some sort of context for you, that is higher than the annual GDP of several mid-sized countries.
Yeah, it's wild.
But honestly, the absolute number wasn't even what impressed Wall Street the most.
Yeah.
It was the growth rate. We are talking about a 16% increase year over year.
Right. And that's actually where I want to push back just a little bit because, okay, 16% is fantastic.
But we've also seen inflation running pretty hot over the last couple of years, and we know they bumped the prices on the Pro models. So how much of this is organic growth? Like, are they actually selling 16% more physical units, or are they just charging people more for the same amount of phones?
That is the perfect question to ask. If you dig into the segment breakdown, it's a mix, but their premiumization strategy is absolutely doing the heavy lifting here.
Premiumization, okay.
Right, meaning they aren't necessarily shipping 16% more iPhones by sheer volume. What they're doing is convincing you, their existing user base, to move up the ladder.
To buy the Pro Max instead of the base model.
Exactly. They're selling more Pro and Pro Max models than ever before. So even if unit growth is just, modest, the average selling price, the ASP, is just skyrocketed.
So they've successfully convinced us all that we desperately need the titanium finish and the slightly better camera lens.
Yeah, basically. And I mean, that is a lot harder to pull off than it sounds. When you get to this scale, the law of large numbers usually kicks in. It's incredibly difficult for a company making $400 billion a year to grow at double digits.
You have to move mountains to move the needle.
You do. And yet, not only did they hit 16% this quarter, but management is actually guiding for Q2 2026 to be in that 13 to 16% range as well.
Wow. Okay, so this isn't just a one-off holiday quarter bump. They actually see this momentum sustaining into the spring.
They absolutely do. And that confidence is showing up in the earnings per share forecasts, too. Analysts are now projecting fiscal year 2026 EPS at $8.41. That's a 12.7% jump year over year.
That's massive.
Right. When you combine double-digit revenue growth with double-digit earnings growth at a $3 trillion plus valuation, you start to understand why the stock has been so resilient.
Okay, so the hardware is clearly still the gateway. It gets you in the door. But we've talked about this dynamic on the show before. If you're only looking at phone sales, you are analyzing them like it's 2015. The real evolution, and the reason Wall Street has expanded their valuation multiples so much, is what happens after you take the phone out of the box.
The services narrative, yes.
Exactly.
This has been the core investment thesis for the big institutions for the last 5 years. But this quarter really just cemented it. Services revenue hit a record $28.8 billion back in fiscal Q4 2025, and that momentum just plowed right into Q1.
Nearly $30 billion in services, just in a quarter.
It's insane.
It is. I mean, their side hustle is bigger than the entire core business of most Fortune 500 companies.
That's a great way to put it.
But let's drill down into the quality of that revenue, because making $30 billion selling heavy physical hardware is very different from making $30 billion selling digital subscriptions.
Oh, it's night and day, and this is where the margin profile completely changes the math. Hardware is tough. You've got supply chains, shipping container costs, raw materials, defect rates.
Assembly lines, yeah.
Right. But services, the gross margins on services are consistently above 70%.
70%. I mean, that is pure software-level profitability.
It is. And this is a big bun. We have to be careful not to treat services as just one big monolithic category, because it's actually a blend of incredibly high-margin businesses and some much lower ones.
Okay, break that down for us.
So things like the App Store and iCloud, those are the real cash cows. The marginal cost for them to store 1 extra gigabyte of your photos or to process an in-app purchase is basically zero.
Right.
That's where you're seeing margins pushing 80 or even 90%.
Got it. And that's versus something like, say, Apple TV Plus, where they're spending literal billions to make sci-fi shows.
Exactly. They are burning cash on original content to make the whole Apple One bundle more attractive. So when you see that aggregate 70% margin, it's actually masking the fact that iCloud and the App Store are massively subsidizing their Hollywood ambitions.
That makes total sense. But the net result for you as an investor is a revenue stream that is sticky, predictable, and wildly profitable. It fundamentally makes the company less reliant on whether or not people upgrade their phone this exact year.
It smooths out the lumpiness. If you don't buy the new iPhone 17, you're still paying your monthly rent for iCloud storage because you don't want to lose your photos.
Rent. That is the perfect word for it. It's digital rent.
And the reason they can charge that rent so effectively is the installed base. We are now looking at 2.5 billion active devices globally.
2.5 billion.
Just think about that as a distribution network. If they decide to launch a new service tomorrow, maybe a new fitness tier or a new savings account, they have instant, friction-free access to 2.5 billion endpoints.
Wow.
No other company on the planet has that kind of direct build relationship with high-income consumers.
It's like they built their own digital city, and they're the only landlord allowed to collect tolls on the roads.
Precisely. And that brings us straight to the balance sheet, because when you have the hardware engine pulling in cash and the services engine generating 70% margins on top of it, the amount of cash piling up is frankly absurd.
Yeah, let's look at those numbers. Because in Q1 alone, they generated nearly $54 billion in operating cash flow.
$54 billion?
In 90 days.
It's almost comical.
Yeah.
But it actually creates this high-class problem for the management team, which is, what on earth do you do with all that money?
Right. And this brings us to the buybacks. They've got a $110 billion share buyback program. Now, I want to play devil's advocate here for a second because I know what some listeners are thinking.
Sure.
When I see a tech company buying back its own stock at all-time highs, a part of me thinks, do you really have no better ideas?
Right.
Why not buy a massive competitor? Why not double your R&D? Is this just financial engineering to artificially juice the EPS?
That is a very common criticism, and you'll definitely hear the bear camp hammering that point. They argue that massive buybacks are essentially an admission that the hypergrowth phase is over.
Right.
However, you have to look at the practical constraints they're under. The company is so large now that they literally cannot make a massive acquisition without antitrust regulators in the US and the EU instantly blocking it.
That's true. They can't exactly just go out and buy Disney or Netflix tomorrow. The government would step in immediately.
Exactly. So they are effectively forced to return that capital to shareholders. But look at it from your perspective as an investor. By retiring those shares, taking them completely off the open market, they are mathematically increasing your ownership stake.
It makes the slice of the pie bigger for everyone who holds.
Exactly. It mechanically boosts the earnings per share. Even if their net income stayed totally flat, if the share count drops, the EPS goes up.
But in this case, the earnings are actually growing while the share count drops.
Right. It's a double-barreled shotgun for value creation.
And they also bumped a dividend recently, didn't they?
They did. Up 4% to 26 cents a share.
Which, I mean, it's not a huge yield on its own.
No, but when you combine the dividend with the buybacks, the total shareholder yield is actually very significant. And the key here is they are doing all of this while maintaining a net cash position. They aren't taking out crazy debt to fund these buybacks like some distressed legacy companies do.
It's all funded by operations.
Purely from the cash they generate day to day.
Okay, so the financials today are pretty much bulletproof. But we need to look ahead. Because you can't just buy back stock forever. Eventually, you need actual product innovation. And right now, the only thing the broader market really cares about is artificial intelligence.
Unquestionably.
For a long time, the dominant narrative was that they were caught totally off guard by ChatGPT,
Yeah.
that they were lagging behind. Has that narrative shifted with the 2026 outlook?
It has shifted dramatically over the last 6 to 8 months. I think the market finally woke up to the fact that the consumer AI race is fundamentally different from the enterprise cloud AI race.
Right.
They aren't trying to build a better search engine to rival Google, and they aren't trying to build massive server farms for other companies to rent out. They're just trying to make your specific device smarter.
So this is the whole edge AI strategy we've been hearing about, processing on the device.
Exactly. And to pull that off, you need incredible silicon. You need chips that can run these heavy language models locally in your pocket without draining your battery in 30 minutes.
And that's the M4 chip,
That's the M4.
which actually explains some of these capital expenditure numbers we're looking at.
Yeah.
I noticed their AI CapEx is up 35% year over year, hitting $12.7 billion.
Right. Now, if you compare that 12.7 billion to the hyperscalers, the company spending 40 or 50 billion, it might look a little small.
Yeah, it looks conservative.
It is conservative, but it's disciplined. Because again, they aren't building general purpose data centers for the whole world. They are building highly specific infrastructure solely for their own ecosystem.
And speaking of that infrastructure, we saw some news about where it's being built, which I thought was super interesting. They are expanding manufacturing in Houston to build the Mac Mini and AI servers.
Yes. This is a incredibly strategic move on a few levels. First, it fulfills some major political commitments to boost U.S. manufacturing, which, let's be honest, keeps the regulators and politicians happy.
Oh, for sure. It's good PR.
Right. But secondly, and more importantly for the business, it secures their supply chain for the most critical component of their AI backbone. They are bringing the server production closer to home.
So it's security through localization, reducing reliance on overseas assembly for the most sensitive AI hardware.
Exactly. And all of this ties directly back to their primary moat. Why do they win in AI? Is because they already have your data. They know your location, your heart rate, your text messages, your daily schedule.
Yeah, it's almost a little scary when you list it all out.
It is, but, and this is the genius part, they have spent the last decade positioning themselves as the ultimate privacy company. So they can say to you, look, we are running these AI models locally on your M4 chip or on our private silicon servers, so we can give you a hyper-personalized assistant without ever selling your data to advertisers.
And that's the big differentiation. Because
Right.
Google and Meta, their entire business model relies on serving you ads.
Yeah.
So their AI inherently wants to mine your data. But here, the business model is just selling you hardware and iCloud space.
Yeah.
They can actually afford to be the private AI option.
And that is a massive, massive selling point for premium consumers. It just reinforces those switching costs we talked about earlier.
Right, because if you leave the ecosystem now, you aren't just losing your blue iMessage bubbles. You're losing this deeply integrated private AI assistant that knows your whole life.
Exactly. It makes leaving incredibly painful. And you can see Wall Street buying into this. Just look at the analyst sentiment. We've seen 9 upward revisions in earnings estimates in just the last 60 days.
Wow, 9 revisions up. That's bullish. But, and we have to do this, it is not all sunshine and roses.
No, never is.
We have to look at the risks. And when you look at the geographic breakdown, there's one giant red flag on the map that we simply cannot ignore. China.
Yeah, the China situation is undoubtedly the biggest drag on the stock right now. If you look at the recent quarters, revenue in the region is down roughly 4%.
And a 4% drop is glaring when the rest of the company is growing at 16%. So what is actually driving that? Is it just a sluggish macroeconomy over there, or is it direct competition taking market share?
It's a combination of both, but honestly, the competitive aspect is what has investors sweating. Huawei has made a pretty stunning comeback. They managed to mass produce a 7-nanometer chip despite all the U.S. sanctions, and they launched a flagship phone that is legitimately competitive.
And there's a strong geopolitical and patriotic angle there too, right?
Yeah.
Like choosing a local brand over a Western one?
Absolutely. There is a very real nationalist buying trend happening in mainland China. Plus, you have the government unofficially restricting iPhone usage in certain state agencies and state-backed companies. So you're getting squeezed by regulatory pressure on one side and highly capable local competition on the other.
Okay, so is the growth story there just over? Have we seen peak Apple in China?
Well, management says no. On the call, they guided for a rebound in Q1 2026. They are projecting that the recent drop was more cyclical, tied to some supply chain timing issues and currency headwinds, rather than a permanent structural decline.
But do you buy that?
As an analyst, I'm pretty skeptical. I think the golden era of 20% year-over-year growth in China is probably behind us. From here on out, it is going to be a grueling battle to just maintain market share.
So that's the main watch point for listeners. If that -4% bleeds into a -10%, the whole global growth narrative shifts.
It absolutely does, because it would put an immense amount of pressure on places like India and Latin America to suddenly pick up all that slack.
Right. Now, what about the valuation risk? Because we're in this massive tech rotation right now. Everything AI adjacent is flying. Is it possible the stock is just getting too expensive?
It is priced for perfection. There is zero doubt about that. When you're trading at these kinds of premium multiples, any slight misstep, whether that's a delay in the M4 rollout, a bug in the new Siri features, or even just a slight miss on services revenue, can trigger a pretty sharp correction.
Because the market is already pricing in this idea that the AI features will trigger a massive, unprecedented hardware upgrade supercycle.
Exactly. And if that supercycle turns out to just be a normal average upgrade cycle, the stock will likely re-rate downwards.
So the bar is set incredibly high.
It is. But I will say, historically speaking, betting against this specific management team's ability to clear a high bar has generally been a losing trade.
Fair point. Okay, so let's try to synthesize all of this. We've covered the $143 billion revenue, the 70% margins in the services sector, the fortress balance sheet funding these huge buybacks, the whole localized edge AI strategy, and of course, the very real risks in China.
Yep.
If you had to give your elevator pitch to the listener who's looking at their portfolio right now, wondering what to do with this stock, what is a final verdict?
Here is the synthesis. You are looking at a company that has successfully transitioned from being just a hardware manufacturer to being a digital lifestyle utility. They have an active moat of 2.5 billion devices that is virtually insurmountable for any competitor.
Right.
They are generating so much free cash flow that they can casually buy back $110 billion of their own stock, which puts a massive floor under the share price. And they are entering this massive AI paradigm shift, not as a laggard, but as a privacy-focused leader with their own highly advanced silicon.
So even with the China headwinds, you feel the pros heavily outweigh the cons.
Heavily. I am giving this a bullish score of 9 out of 10.
Wow. A 9 out of 10. That is a very high conviction rating.
It is, but it's a reflection of the safety you get combined with the growth. In today's market, finding both in one place is incredibly rare.
And what's your time frame on a play like this?
This is a multi-year hold. You own this into the maturation of the AI cycle over the next 2 to 3 years. This isn't something you try to swing trade for next week. It's a foundational cornerstone for a long-term portfolio.
I think that's the big takeaway here. The ecosystem is really the ultimate hedge against almost any market condition, because it isn't just a phone anymore. It's essentially the operating system for your entire life.
It really is.
And as long as you and I and 2.5 billion other people are willing to pay a premium for that seamless integration, the shareholders are going to keep winning. But it leaves you with an interesting thought to chew on. At what point does this ecosystem become so essential, so invisible in our daily routines, that it's regulated like a public utility? Water, electricity, Apple. It's something to watch as they get even bigger.
That is the big question for the next decade. Absolutely.
Well, we covered a lot of ground today, from the billions in buybacks to the new server racks in Houston. We hope this breakdown helps you truly understand what you actually own when you see that ticker symbol sitting in your brokerage account.
Always a blast to dig into these numbers with you.
Same here. And thank you for listening to Smart Wealth with Joshua. If this analysis brought you some value today, please remember to subscribe, drop a like, and leave us a comment with what you want us to cover next. We'll see you in the next one.